Welcome to CIO Insights. This is Sadiq Adatia, Chief Investment Officer for Sun Life Global Investments. Now, before I start, I really want to make sure that everybody out there is doing fine, healthy, and safe. This definitely is some unprecedented times that we're going through. It's impacted our work, it's impacted our personal life. And though I hope things will change, over time and get much better, this could last for much longer than expected. And when we get back to normal levels, this may not be the normal levels we were once used to. It may be a more readjusted, balance of our lives. And so hopefully as time goes on, we will start getting more and more comfortable with this current situation and how we adjust our lives, going forward. So there are a lot of key events that have gone on over the last few weeks. In particular, what the Fed has done in terms of stimulus to the economy, the fact that they continue to talk about how they're going to apply more stimulus going forward, but also, what's going on with potentially opening up the economy. That is a very important one right now that a lot of optimism is placed on. It's also important because tied to opening up the economy is the fact that the belief is that the virus has been contained. And to that extent, the opening of the economy to a lot of people look like less risk, now compared to maybe 3 or 4 weeks ago. And that will be important because not all economies in every city and every country will be opening up at the same time. It will be staggered, and people will be watching that carefully to see if any additional outbreaks occur and paying attention to what's going on with China, because China particularly has gone through this particular scenario and is starting to open up its economy. And then the last thing that we want to watch for carefully is really what is going on with jobs out there. We've seen significant amount of job losses coming through. And the question is that when the economy starts to open up, will these temporary job losses, come back to being, jobs again, or will they become more permanent? And that would obviously be a very bad sign for the economy. Yeah, the first important event we're going to pay attention to here is really when we open up the economy. We want to see what happens with companies. How are exactly they're going to start up their businesses. And I'll use Shanghai, Disney Shanghai as an example, where they've opened up and things look really, really good. They were only at less than 30% capacity because that's all they're allowed to do. But demand was there to come to those parks and things seem to go off relatively smoothly. And that's the type of things that you want to see when the economy opens up. That when you open up, the demand comes in at the expectation that you're looking for, and everything runs smoothly. Now, I don't think that will be true for every segment. I'll use movie theaters as a good example, where that might be a lot more constrained than otherwise expected. And so, some areas will be a lot stronger, some will be weaker. It'll give you a sense of where things should be, money should be moving in which direction and where you should try to stay away from, given the uncertainty there. The second thing to keep an eye on is that today we feel that the market is pricing in a perfect economy, a perfect opening, a perfect transition. And that's a very high bar. Right now, it's shrugging off any bad economic data coming through, including the job losses. If that continues on, then that means that there's a lot of upside potential still left in the markets. On the other hand, if we start to see some continuation of negative things coming through, and they're in doses rather than in singular events, then potentially we could see markets really react quite negatively to that and have a second leg lower. And that's what we actually expect might happen as this economy opens up and more surprises pop up. So given that we are expecting that markets may pull back a little bit as the economy opens up, that everything is priced in really, really well for a perfect opening, we think there's a lot of risks potentially coming through when we do open up. As such, we want to be underweight equities, but not significantly. And the reason why we're not significantly underweight is because the fact that I did mention earlier that there are some upside risks still here. One of them was the fact that the markets are shrugging off bad data, but the other one is that we could still see some positivity coming out on the vaccination front. Whether that is some positivity on a cure or even more test kits or faster results coming through, better immunity, all those things would be a good positive across the board. And market will probably bounce really strongly on those news. So we don't want to go significantly underweight equities, but at the same time, we do feel that there is more downside here than upside. And so we do want to be underweight equities across the board. Now, within the equity space, though, what we've also tried to do is move towards higher quality. And that to us is the US equity market. It is one of the stronger economies. Governments have a lot more stimulus at their disposal. And then if you think about companies, they were stronger heading into this, and they're going to be stronger heading out of this as well, after all that stimulus that's put in place. So we want to overweight the US economy. We want to be underweight areas like Canada because of the oil sector in particular, but also international markets that are tied heavily to growth in terms of tourism. And the fact that tourism really is going to be at a standstill for quite a bit of time, we think we want to be underweight that international market, along with the fact that it still has those Brexit issues or somewhere down the road as well. And then if we think about the bond space, we want to still focus on high quality there, and that's still, I think, our better approach to go forward. But we do want to start to take on a little bit more of that credit risk. Credit is at a discount today, rightfully so, but they are attractive for long-term investors. And given that's what we are, we want to start to add a little bit of that credit exposure, as markets continue to head lower over the coming weeks and potentially months.